Good morning, ladies and gentlemen. Well, by my calculations manually, we are at -30, but improving in the risk dial. And I think we're going to get two-way volatility now for quite some time. We probably have seen the low for the next few weeks, and I'll investigate now what would change that situation. And the only thing would be a complete debacle in the yield curve and in the bonds. And we know what that means, but we will investigate each one and the reasonings now. The yield curve net on the week had a very small change, but it also had quite a volatile week. Up and down. And the reason, I believe, is the forwards. They have basically returned to where they were back throughout the throughout the year at the higher level of the range, which is around the 240 to 250 area. This is the five-year forward expectation rate. And this one is the 10-year break-even inflation rate. They have basically returned to where they have been at the highest levels throughout this year, back in a range, which should suggest that we are basically going to have stability again in the bond market, with the yield curve swinging wildly according to the latest data. If inflation is higher than expected, we will have a huge inversion of the curve, because I think now what is definitely happening is that people are beginning to take the Fed's warnings seriously, that they are going to do whatever it takes to tame inflation. If inflation keeps on being stubborn, which are the odds, I think not only 75s are on the cards, but even hundreds or 200s. And the yield curve is going to be swinging wildly around the 30-year area. I think 30s are probably going to be the most stable, and the 2s and 5s are actually going to be the most volatile. And here we have the 5s, 30s on a daily basis. Never quite got to the level that I wanted to get out. Back to the line, closed below it. It really doesn't mean very much. I think this is going to be very volatile, not now, but in the weeks to come. As I've said, if the inflation data persists on being higher, and we have a long time to wait to find out about that, therefore I think it's going to take quite some time to find out, this is going to swing wildly. I really would not be surprised if the inflation data, next set of inflation data we get is bad, if we go full inverted. The Fed is running out of time. Everyone, we all realize why the inflation is happening, but that is no consolation to the Fed if the base effects do not bring it back into stability, back down towards the 2% range. If inflation now is going to settle at a 5 or a 6 or even at a 4% inflation range, that is something that the Fed can't tolerate. And if they can't tolerate it, then that means that they really have to start hiking much quicker. And if that happens, the curve is really going to go very inverted, and we are going to have a very hard landing for the economy. But the Fed told us now that the hard landing is something that they are prepared to tolerate. So what does that mean for equities? It means that the Fed put is a lot lower than people think. And really what the Fed is doing is writing calls at the moment. And I'm quite convinced that the upside in all these markets, including the bonds, in terms of futures prices, is quite limited. And the downside is very, very much open. It's much more open in the 2s and 5s than it is in the 30s as a result of this strong restatement of Fed policy. And it's much more open on the downside in NDX than it is in SPX. But all of these have got open downsides. Not now, because we need to find out what the data says. And it's going to take at least 1 or 2 months to find out. But after that, the downsides are very, very open. In terms of the individual tenures, I expect a sideways period. This is a weekly chart of the 5s, and this is what I expect. Sideways trading between 267 and 3%, maybe 308, but I doubt it. I think that we are going to spend a considerable time now, probably 4 or 5 weeks, going sideways, waiting to see what the inflation rate does next. And if it's higher, we go much, much higher. If I try and show you this, I think we probably can go to 350, if not all the way to 5%. So this is the kind of stuff that I expect. If unless inflation starts coming off very quickly to levels that the Fed can tolerate, just between 2 and 3%, which I doubt is the potential. I think every single piece of macro that I look at says that inflation is going to settle higher. Then the Fed will really have to ramp up the hikes, and I really wouldn't rule out short-term rates in the 5%, 5 to 6% in the next year or so. In terms of the 10s, I think 273 to 269 is all she wrote as far as potential to the downside. I would be shocked if over the course of the next 2 to 3 weeks we see any better levels than these. And in terms of the 30s, here we are on TLT. I'll give you the change of TLT. I would be shocked to see much better than this kind of level, 121, let's call it 121 and odd. And in terms of the 30s, really I would not expect to see much lower than 294, or maybe slightly lower. But 294 to 272, I think, is going to be about as good as you can get in 30s before we see what the next leg up is. So those are the levels that I would write calls against in futures for the next 2 or 3 weeks, and also the levels that I would be interested to do swing longs on the 10s and 30s. I think in Europe the levels are very clear. What is happening in Europe? Well, I would say that what is happening is simple. The ECB is way behind the curve, but they could get rescued by the Fed and a very weak economy. We will see what the data is in the next few weeks. There is not really going to be much speculation of any sort before the ECB in June, and then basically Europe goes on holiday for 2 months. But I think the levels are very, very clear. The risk reward is that inflation is a global phenomenon. The risk reward is that they have to tighten much more than they think or the market currently thinks to tame an inflation which is becoming structural. And therefore, in the Schatz, the level is this one, is -9 basis points. If you get there, you have a wonderful risk-reward opportunity to go in large, because I think that if we change this to a monthly, my bet would be that we go up here. Okay, that would be my bet. Can we go sideways now for 2-3 months? Absolutely, but the risk reward is that we go much, much higher in yield. If we go that to the fives, to the bobble, I think it's quite clear now, this is a daily chart, that we might do a little bit of a head and shoulders and then come down to this area around 27. Again, I think that would be a wonderful opportunity for higher rates. And if we change the to a Bund chart, I think that we are most likely to trade again around the 79 area and basically do something like this for a couple of for a few weeks, but then the risk reward changes there as well, with a lot more stability in the Bunds than we're going to get in something like the Schatz. The French market basically says it all. Very clear chart. This is the level that you're going to look for, 114, 115, and there you go, basically options short on the futures, looking for anything around the 2 area. Why is the dollar strong? Well, the dollar is strong because the differential in interest rates is strong, is large, and keeps on being quite constant around the 200 mark in the 10s in Germany and the US. I would argue that you're not going to see a weaker dollar until that starts breaking 185. I have that level set for me. Unless it starts breaking 185, you're not going to see a weaker dollar. I think that would be the signal for a weaker dollar, but until and unless that happens, any dip in the Dixie looks viable. And here we have the Dixie, and it's really impossible to be short of it. Why would we be short of it at these levels? You're looking for dips down to 102.82 to buy it, basically. That's all you can do. And where can it go? As I said, almost impossible to say. This is the 102.82 level. You're looking for 106.25 and 111. Those are the levels that you're looking for. And really the trigger is going to be given to you by Euro USD. Any weekly close below 103.40 and you're going to get extension. Could it, I would bet that it's going to go sideways another few weeks, basically doing something like this. And why would I think that? Well, because the differential, I doubt very much that bonds are going to have a bad time over the next 2 or 3 weeks. I think, as I showed you, they will range trade down. In which case, the immediate impulse for Euro USD to go down, I don't think is there. People will be slightly afraid of pushing things too far ahead of the June ECB, I would have thought. So, price action like this, 2 or 3 weeks of sideways, working off all the overbought conditions in the Dixie, why not? But I think any weekly close below this level, 103.40, is going to be very, very problematic. Well, gold had actually a very bad week. My patience was more than rewarded in buying it, an effective rate of 1824. But it went straight through me and, pissed straight through me. I've been asking myself why. The strong dollar is obviously a very good reason not to be buying gold. The fact that inflation expectations have come back is also a negative for gold. But I don't think that gold is going to go down a million miles, simply because I think the risk that inflation becomes embedded in the system is too great. And what is going to be bad for gold is when short-term rates really start ramping up, if they need to be really ramped up. So what do I expect for gold? Well, really a bounce off this 1791 area that's been the low for many, many times. Look at it here, how many times. And really then a trade between 1791 and 1830. So a period like this, sideways waiting, probably gold is now dead money for a bit. I don't think it goes much higher than 1830, 1840, unfortunately for me and anyone else. But that seems to be the reality of it. What I'm not worried about is gold moving by itself, and I'm going to show you why. And this is the reason. It's basically cheap, or as cheap as it's been, give or take, whatever it is, give or take 10%, for the last decade against commodities. Now, unless you think commodities are going to get absolutely smoked, the likelihood of gold getting absolutely smoked are very, very low. So I'm really not worried that gold is going to make a move by itself, especially given the fact that silver gold, which I can also show you in a moment, is quite low. And also the fact that this is DBC, it just doesn't want to move from this 28 area. Every time it dips to 26, it's bought. It's more likely now that it's worked off so many weeks of overbought conditions that it actually makes a great big run to this 29.73 area and breaks higher. Well, if it does that, gold is going to get dragged up with it. So unless commodities, you think commodities are going to take a great big dump, I think I'm going to add to my gold around 1791, and I'm going to add 1764, and have an average of around 1790, and then look for a big bounce into the 1830s again. And this is the ACWI against GLD. And this also tells me that, even if we retrace a little bit in here, this is a very, very small peanut move, and that really gold is going to be supported at lower levels. I just don't think that we are having a move in gold per se. I think these are corrective moves in stocks and bonds against gold, and that as a result, gold doesn't really move a million miles from here. And this one is silver gold. It has a little bit of room to go back to the moving average, but it's quite clear that gold is, much better investment than silver. So, and we can probably enlarge this area. I really don't think that it can go much further than this kind of level, 100.12, which really gives me confidence. And I'm really doing this gold, because, I'm long of it, and I know some of you are long of it too. I really don't think that we are in any danger of a collapse in gold per se without other assets going down. This is a corrective move. People, got overly long of gold back in, above above the 1980s, 2000s, and they're just puking it. So, we didn't make that mistake. I think, being a little bit too early is not a bad thing. And I think if you see 1764 in gold, it's time to load up. This chart just, I find it incredible that earnings expectations are not coming down. Okay, they might start going sideways now, but they're still not turning over like they did here. What does this chart imply to me? It implies that this level around 4,200 is going to be absolutely key, but that we are in a sideways move until and unless these expectations start rolling over. This is what the fundamentals tell me. This is what the mathematics tells me. And now let's go and have a look at what the technical charts say. Let's start off with the weekly, and absolutely caught it at almost the low tick. So what do we do now? Well, let's first of all acknowledge something. It's coming down at the speed of the Bollinger Bands, which are basically, let's call it 50, from close to close, 50 odd ticks. So about 1%, just over 1% a week. We've had 1, 2, 3, 4, 5, 6 down weeks. Okay, so we've discounted a lot. What do I think is happening? Degrossing is definitely happening. Don't forget that over the course of the next 2 or 3 weeks, you will get a lot of redemptions from hedge funds. And therefore, a lot of leverage funds probably already anticipated that, or are going to have to do it over the course of the next 2 or 3 weeks. You get the redemption cycle, and we are right beginning of the redemption cycle from hedge funds over the next. So we are now on the 15th, and they need to pay out on the 30th or the 1st or the 2nd, immaterial. So this, over the course of the next couple of weeks, really it's unlikely that the situation is going to get much better. I think hoping for inflows into hedge funds is a bit of a stretch. I think it's much more likely to get significant outflows, but I think some of those outflows have been anticipated and acted upon. This is why we've had this. So what is the likelihood? Well, the likelihood is that we keep on testing the lower Bollinger Bands. So if it was at 14.25 this week, next week we will be at 39.70. So we will keep on trading down to it or maybe below it and then break up. We have this gap here to fill, but really the level that we all know now that we have to break on the upside is on a weekly chart is 42.47. I think there isn't a hope in hell that we do that next week or even in the next 2 or 3 weeks. If we see anywhere near 42.47, it's going to be the risk reward of your lifetime, I think. So that's why I don't think we're going to see it. Basically, you keep on buying these dips to resell the 100-point rally. That's what the weekly chart is saying. To me, looking at the clean weekly charts, and I'll enlarge it for you, the levels that we are looking for really to start thinking about the risk reward of shorts, rather than the 42.50s, is much more likely to be 41.28.80. That is far more likely to be the level that we can do some shorts and then do some more at 42.50 in terms of put spreads. It just is unlikely that we go much beyond this area, simply because, as I showed you in the Blue Angels, that is where the times 18 comes in. And if we get stability in the bond market, as I think we will, there should be that compression of price action. And that is really what we saw on Friday, when volatility, and I'd rather show you that now, when volatility basically collapsed and closed through 30. A close through 30 on the weeklies is bullish for prices and bearish for the VIX, and tends to indicate that we will trade down to the 25 to 22 area. We have a small gap here around the, 25.42. So my bet is that we will come down to it, and then we have another gap up above. And I can enlarge that and show you. And I bet you that we fill both of them, which tells me that we are likely to have continued two-way price action, testing of that low on the Bollinger Bands on the weeklies, and also getting towards, where would we be here? So this date, have a look at it. This date is the 0504, and if we go back to the if we go back here to the and here we are, if we go back, so that is 0504 is here, and this gap here, which is 42.55. Okay, so everything points to this area between 41.28 and 42.55. That is going to be our very interesting area to trade and to look to set some longer term shorts. What does that imply for NQ? Well, if we're looking for that area in SPX, really we're looking for this kind of area, 13,400 in NQ. I think that is going to be between 13,113 and 13,400 is going to be the level that you really want to start buying put spreads. You fill one, you go up. I think all the dips here are going to get bought. Okay, so don't get short down here, but not on your Nelly. I mean, just no point. I think you're going to get a violent reaction one day. One day you're going to get some good piece of data. The bonds are going to do slightly better, and this thing is just going to fly up to 13,400. That is the area that you really want to do something. 13.1, 13.4. Before that, don't think about it. Europe is the one that said, and Japan basically said no to the equity move in the US all last week. And that's why I had confidence to buy the dip. I think they will continue saying no for some time. What do I think about Europe? I think it will now trade in a range between 36.45, maybe slightly lower, and maximum this kind of level, 37.60. I will be, I'll be looking to do some shorts between 37.60 and 38.43. That is the kind of range that I'm looking for. I think it'll now that it anticipated the States, it'll move to the upside less than the States. That's what I think is more likely than not to happen. And I know that Europe and Japan have been buoyed by the currency moves, but I don't think that that is going to go too far now. And lastly, I want to show you why I don't think we're going to move too much on the downside, or we have all that much downside in equities. I think this is SPY over XLY. This gave us the move, okay? This gave us the move down. I think we're more likely to retrace this spike, and that is going to give some stability to the market. We're likely to come back to these levels, and that gives us stability. And if we have a look at something like this, which is the equal weight consumer staples to discretionary, this also is a long way away from its moving averages. It gave us the signal to get short, and now it's going to come back and fool around with us at these levels, and give the market time to digest. So again, the two-way action: you buy the dip to resell it somewhere around the 41.28 area and get really short around the 4200 area. Lastly, JPM 116.02 traded. I got some, it's rallied. I think it's more likely to trade this kind of level, 127, rather than break straight through 116. Those are the odds, and that's what I'm playing. I'll be well out at this 126.80 kind of level. I'll be well out. I won't even be thinking about it. But to me, we are more likely to range trade and gap fill. And if we have a look at Apple, this is the first time we closed actually below the Bollinger Band. I think Apple can easily do a above 155 to screw everyone and then come down. So that is why I think the sideways to higher has a much better probability than not, and therefore any kind of a dip to below to where the weekly Bollinger Bands will be, which I showed you is going to be somewhere around, if we go to it, here it is, it's going to be somewhere around 40.43. I think 40.43 is going to be a wonderful level to buy calls, looking for finally a green weekly candle which could go all the way into the 4100s and basically screw everyone. I would not be surprised to see the mid 4100s sometimes next week, just on a squeeze basis. I've put all the levels in here. I think the next 2 weeks are going to be periods of great patience. I mean, you have to exercise great patience and get in really good levels. I think it'll be sideways markets, and therefore levels are even more important than usual. I've also included here a good video that I've watched, and an explanation as to why higher multiples are unlikely. If higher multiples are unlikely in the short term, that means that the upside is capped, and it's only a question of which upside target you think is going to be the top. I showed you mine. I really find it very, very hard to see the market above 4,200 in the next month. And I will basically be trading accordingly, and I will tweet you every day what I see as potential and what the best trade from those levels will be. Thank you very much indeed, and tweet you tomorrow.